Welcome to Inside the Fortress, the show where we deep dive into the tools, trends, and techniques shaping the financial strategies within the equity indexed insurance and annuity market. I'm your host, Ashley White, and today we're getting under the hood of one of the most misunderstood engines in the insurance world, equity indexed life and annuity products. I say one of the most misunderstood engines because it seems the deeper we go, the more there is to learn. Joining me today is Michael Barada, president of Fortress Brokerage Solutions, an industry veteran who's here to decode what really drives growth in these products. Today's host is a seasoned expert in the financial services industry with over 25 years of hands-on experience. Michael has worked extensively as an insurance producer and is the founder of Fortress Brokerage Solutions, where he supports insurance and financial professionals across the country with tailored products, strategic case design, and an in-depth product expertise. Holding insurance, investment advisor, and security licenses, Michael brings a wealth of knowledge to the table, empowering producers and educating consumers alike. His insights have helped countless advisors elevate their practice and deliver outcomes for their clients. Hi, Michael.
Hi, Ashley. Thank you, and it's great to be here.
Let's jump right in. What are the main drivers of equity indexed insurance and annuity products growth?
Well, obviously, the easy answer is the actual indexes that you're picking inside of the contracts. But there are so many other nuances that are pertinent to the growth inside of a contract, and those are really the main drivers of growth within the contracts themselves.
Earlier off, Mike, you pointed out something that's both common and concerning. Many insurance professionals not only misuse, but also misunderstand the key terminology in these products. Let's start there. Because mastering the language isn't just academic. It's the foundation for making smart decisions and communicating clearly with both clients and carriers.
So you're absolutely right. There's some really interchangeable terms that people end up utilizing and they use them incorrectly. Let's go over three specific ones.
Okay.
The first one is going to end up being the investment account. The investment account is primarily the index that you're going to select within the life insurance contract or the annuity contract. Obviously, the main engine of everything that's there. The second terminology is something called index segment. And the index segment is going to refer to either a 1-year segment, a 2-year segment, or a 3-year segment. So in other words, a 1-year segment is that the index starts at the beginning of it, and at the end of 1 year, you end up getting crediting rate. At the end of a 2-year segment, of course, it starts off with its index, and after a 2-year period of time, whatever that segment goes out to, that's your segment return that you can get on your investment, and so on and so forth for a 3-year segment, a 5-year segment, so on and so forth. The third thing that you have to end up looking at in terms of terminology is something called an investment bucket. An investment bucket can end up being, you can have multiple buckets in a segment in a calendar year. So for example, the S&P 500, you can have a January bucket, along with a February bucket and a March bucket and an April bucket and so on and so forth. So you can not only diversify amongst investment strategies and investment term segments, you can also diversify in terms of your investment buckets.
Okay, so with that in mind, let's focus on investment accounts. With so many options, U.S. and global stocks, real estate, commodities, accounts with fees, bonuses, or higher crediting rates for a fee, how should advisors evaluate these choices and make informed decisions?
Well, the industry has really evolved over the years. If you're talking about many years ago where all you had was a whole life contract, the only thing that you had to end up depend upon was a dividend to go out and provide an investment return on your contract. So that was kind of like a set it and forget it style contract. Then all of a sudden you had Universal Life come into the mix, and initially Universal Life had a fixed account, another set it, forget it moment in life insurance. Then all of a sudden you started variable universal life, where you had all of these different investment accounts inside of the variable insurance contracts. Now, those had to really be managed in order to optimize your return within the contracts. Then the evolution came into the fixed market where you were able to go out and have investment buckets utilizing the S&P 500 and maybe a fixed account. And that's how indexed universal life kind of started. So that was really kind of a set it and forget it as well, because you only had one bucket. Fast forward to the evolution of today, you might end up having 12 or 15 different investment accounts inside of a life insurance or an annuity contract to select from. So now all of a sudden you have so many different selections. The sophistication has gotten so great, it takes an additional level of management in order to take care of those.
So talk to me about these approaches.
Well, putting my investment advisor hat on, as far as the markets go, there's several different ways that investment advisors come and really kind of approach investment strategies. They either approach it from a top-down approach or from a bottom-up approach. Let me explain the top-down approach first. That means that you end up taking a look at the entire world economy, the entire United States economy, or the European or the Asian economy, and where is it going to end up going in today's environment? Do you believe that the growth inside of that is the forecast that it's going to end up being greater, equal, or less than where you're going to end up being in a year or 2 years or 3 years? And then once you end up figuring out those particular geographic regions, then all of a sudden the investment advisor is going to come in and he's going to look at the specific sectors within those regions to figure out which sector is going to end up being the best one to invest into. Then past that, they'll go into the best companies within those sectors. Our products don't specifically get into the companies within the sectors, but you can get relatively granular inside of the products that we go out and we sell. The products that we distribute. As far as the bottom-up approach is concerned from an investment advisors at that point will go out and take a look at the strongest companies down at the bottom. They might take a look at free cash flows. They might end up taking a look at what the growth is of that industry, what the growth is of that company within the industry, and that's what's called a bottom-up approach. If they feel that that particular sector that those companies in are going to be better than any other sector, they'll take a look at the best sectors and the best companies within that sector, and that's how they build their portfolios. Now, within the insurance industry, you should really take that top-down approach to looking at the investment accounts. Let me give you an example. The S&P 500 is a good example, okay? In the S&P 500, out of every 10-year time period, there's typically 7 positive return years and 3 negative return years. Okay? So the idea is how do you go out and how do you limit those negative return years? Even though we have a 0% floor and we have always said that 0 is your hero in the equity index component, how do you end up getting positive returns within those 3-year periods of time?
That's 30% of the time.
That's 30% of the time. If you can eliminate that to only 10% of the time, if you can go out and you can end up getting 2 additional years of crediting within your contract, then what that means is that extra compounding that you're going to get for those years is just going to be a massive amount of money sometime in the future.
Absolutely. So you're saying that a regular review is key in these contracts.
Exactly. You really need to take a look at when the indexed buckets come due. You want to find out, and you really want to go out and have an idea of where the economy is at and whether your client should end up changing those buckets or not to some other investment strategy. And you can always do that 30 years prior to the maturity of that bucket of that segment.
Okay, let's quickly touch in the investment segments and the investment buckets. Within these 2 parts of the accounts, how would you manipulate these in order to manage risk?
Well, there's a lot of ways to manage risk. One of the ways is to dollar cost average your money. And dollar cost averaging, we alluded to the investment buckets that are there. Since these are a point-to-point index, maybe you don't get a crediting rate in a January to January bucket, but you can end up getting a crediting in a March to March bucket. So If you dollar cost average into these investment buckets, in other words, I've got $12,000 that I'm going to put into this product. And I want to end up having 1,000 put in January, 1,000 put in February, 1,000 put in March, 1,000 put in April, and so on and so forth, so that you have $1,000 in every single bucket within a year. That's a great diversification technique, because now you're taking out those rogue years where maybe in January something happens where there's a big tsunami in Japan or something like that, and it causes the stock market to go down just in January, and then it comes back up in February. So that's a great diversification technique. The other technique that you should really look at is, with all of these different investment strategies that you end up having, you've got global investment strategies, you've got domestic investment strategies, you've got portfolio investment strategies like we have in some of the products that we go out and we distribute, where you actually have stocks, fixed income, and commodities as a investment inside of that index. And that helps to go out and control volatility. It helps to control diversification as well.
Okay. Now let's get into the real engine, the nuances that can really enhance or even reduce accumulation values. What should advisors know about these nuanced?
Oh my gosh, there's so many of those to really take a look at. And many advisors really don't know all of the nuances of these products, but a good example is partial index credits. One of the items that I end up seeing in a lot of these products is people have deductions out of these accounts for cost of insurance. They have deductions out of these accounts for withdrawals, surrenders, loans. And the problem is that when money comes out of these indexes, unless it actually comes out after that index matures, if you should have positive growth in, let's say, the S&P 500 halfway through the year of 10%, right? And you take money out of that account, you just lost the index credit for that half of year period of time.
You got a zero.
You got a zero out of that.
Yeah.
You just got your money back. And you still had the expenses within that segment that you had to end up paying. But we have a carrier that actually offers something called partial index credits, so that if you should take that money out halfway through the year, you're actually going to get crediting for that halfway period through the year. You see, in these investment accounts, we use option strategies to go out and build these crediting rates within these contracts. And on a one-year segment, you have a one-year option that you're purchasing, right? So if you have profit halfway through that year, and you should take the money out, and the insurance carrier doesn't give you credit for it, they just made profit on that half a year. This one carrier actually gives you that profit back in partial index credits.
That would be huge for the really big cases that are out there. I mean, maybe not so important for the smaller ones, but the cases where there's a lot of cash built up in those accounts, compounding interest on even 8 months of a credit is huge.
Oh, it's massive. Just take, for example, some of the premium finance cases. Take a look at some of the executive benefit cases. If you have $1 million set up in an index and you should end up needing $500,000 of it, and you're taking it halfway through the year and you have 8% built up in investment credits in that, you just ended up losing $40,000 in that half of year indexed bucket right there. Wow. So it's massive how much that people would end up losing if they're not in the right product and looking at this particular feature.
And you're telling me that there's really only one company that can do this out there?
There's only one company that does that right now that we've had negotiated that strategy.
That's a huge nuance that financial professionals need to be aware of, especially for these more lucrative and larger clients.
Hundreds of thousands of dollars are at stake.
Mm-hmm. Absolutely. All right, so let me ask you this. Life insurance grows this cash value and it allows the consumer to take dollars out of that account. But I think, correct me if I'm wrong, there are different ways in which those dollars can be extracted, different types of loans. How does the financial advisor advise their client on which type of loan to go after in order to continue to grow that account successfully?
First of all, you have to end up understanding how money comes out of a life insurance or an annuity contract. The first thing that money comes out of for cost of insurance, expenses, withdrawals, surrenders is going to be out of the fixed bucket. And you're okay with that because the fixed bucket credits on a monthly basis. So you're going to end up getting your money each and every month out of that fixed bucket one way or the other.
The fixed bucket gives you like a wash loan.
It gives you like a wash loan. Well, no, it doesn't give you what. We're not talking about loans yet.
Oh, okay.
But when it comes on down to loans, the way that they take loans out of a contract is that it does it pro rata, which means that if you have all of these different investments that are there in all of these different buckets, and you end up taking 5% of the 5% of the accumulated value out of the contract, you're going to get 5% taken out of every single bucket pro rata. Now, that can be a problem because of what we just talked about in terms of not getting those partial index credits inside of the contract.
Life insurance and indexed annuities includes caps, par rates, spread accounts. How does all of this work? What does a financial advisor need to be cognizant of when they're looking at the different options that they can choose from for their clients? And also just diversifying their allocations between the different options.
That's another huge nuance that most advisors really don't take a look at. Of course, everybody takes a look at index caps, but they take a look at index caps in the view of how the illustration is going to perform over a period of time. And that's really kind of deceiving in today's environment because of AG 49 rates, bonuses that are put into these contracts, the way that they structure expenses within contracts. The illustration really doesn't give you a good guide as far as the performance of these contracts. It gives you a general idea. But in the industry, we can always end up telling you the illustration will always be wrong after a 30-year period of time. It's never going to be right on. It's either going to be above that number, it's going to be below that number, depending upon how you manage the investments. So caps in a life insurance contract, specifically things like the S&P 500 will have caps. Caps on those were as high as 17%.
Could you imagine?
At one point in time. I'd love to have a 17% cap on an S&P 500 today with a 0% floor, but those are non-existent because of the cost of options and as low as bond rates have come for a lot of these insurance carriers' general accounts. So you do need to take a look at in terms of your cap rates and what's available from those particular carriers, and understand that those can end up being modified by the carriers. They can come down. So you should really take a look at what the historicals are of that carrier and what they've done and where they're at in the marketplace today, right? The second thing is participation rates. That's a big thing that's come into the marketplace, especially with a lot of these excess return investments that are in there, these low volatility indexes that are in there. And participation rates can be anywhere between 115% all the way up to 400%. Uncapped in some of these instances that are there. Other ones that have higher caps can have lower participation rates, like 65% or 75% or even lower than that. But it's something that has to be looked at. The other part that we really take a look at with a lot of the carriers is, what does the carrier guarantee that the lowest cap or the lowest participation rate is going to be inside of that contract?
Right.
Because, these are going to change at some point in time or another. You want to end up knowing what your bottom line is going to end up being in the contract. Who's giving you the best guarantees on the other side so that your account can grow the best it can possibly go out and grow. So there's a lot of nuances as far as caps participation rates that are there.
Let's talk about how to diversify your accounts beyond the traditional indices, the S&P 500 and so on. I mean, there's a lot of different options that are out there. How do you choose between, all right, I want to go American ETFs, or I want to go to global stocks index or maybe even commodities. A lot of people are talking about gold these days. Gold is through the roof per ounce. Like, how does someone choose?
Well, great question. And it's a question that investment advisors take a look at every single day. They try to end up figuring out and manipulate the portfolios to make sure that you're going to end up getting the best possible investment strategy, right? It's called diversification, primarily. You have to diversify your domestic products with your international products. You have to diversify your fixed income products with your equity products. You have to diversify into commodities in some areas, perhaps real estate. You have to diversify your portfolio across all of these different realms, right? There's also something called low beta that you can go out and purchase. Now, beta is the definition of how much a product or an index will change as it relates to a standard S&P 500, Dow 30, whatever index that you want to use. Now, the higher the beta, the higher that's going to end up moving. But,
more volatility.
It can also be the lower that it's going to go than any other stock. Volatility, exactly. So within the strategies that we end up having, we're looking really for consistency of return for a long period of time. So between diversifying domestic, global strategies that include fixed income and commodities and low volatility stocks, I think that that's great to go out and do. We actually have several products that we like to go out and talk to customers about that have a portfolio mix like that within an index. And that portfolio mix, rather than you having to decide to go in all of these different domestics and real estate or anything, it's already in there. You don't have to do that. We've already got that covered for you in many of our products that we have. You just have to know which ones to select.
True. And it comes down to not putting all of your eggs in the same basket.
That's right. Now, there is another style of investment strategy, and it's called excess returns indexes. It's so misunderstood within the industry. Excess returns are a method where the investment company in back of the investment strategy utilizes a federal treasury spread. And what that means is that if that first, let's say the 10-year bond is at 5% today, if the index does greater than that 5%, then you're going to be able to go out and get a crediting rate on that overage of that 5% times a significant participation rate. We have one carrier that has a participation rate on an excess return investment of 410%.
Wow.
I mean,
that's a lot.
You make 2% over that federal treasury rate, and you've made 8.2%. You make 3% over that federal treasury rate, you've made 12.3%. And so on and so forth. The growth that you can end up getting in that index utilizing these really high participation products that are out there are fantastic.
And they're uncapped. So the higher the growth on the bottom line, the higher the return.
That's right. And we're constantly innovating in our industry, okay? We have a new program called a trigger-based investment. Now, most people don't know that because we just came out with it.
It's new.
It's new.
Yeah.
Okay. It's one of the innovations that we're now offering on a specialized product that we end up having in our marketplace. Here's how that works in today's market. If you have any growth in the S&P 500, we're going to give you 8%. It could be 0.1%. It could be 3%.
It could be flat?
5%. It could be flat.
Wow.
We're going to give you 8%. Now, if it goes up to 12%, you're still going to get 8%, okay? If the S&P 500 goes down by 10 percentage points, we're going to give you 2%.
Wow. So you have a higher floor than a zero in this instance.
Our floor is a negative 10% of the S&P 500, and you still get 2% between 0 and a negative 10%. Now, anything underneath 10%, you have a 0%
You
floor.
lost. Okay.
But the idea here is that we want to end up offering something to the consumer that you're going to have an almost 90% probability of getting a return so that you can get that compounding and get that accumulation account up the way that you need it to be. So that's a new innovation that we ended up doing within that market. I really think that that's going to end up being a significant driver, and I think advisors should really pay attention to that as a good solution for them.
I mean, it takes the conversation of having an annual review to the next level, as opposed to having your client come in and sitting down and saying, hey, look, I'm sorry you didn't make anything this year. Now you say, hey, the market was flat and you got 8%.
Yep.
That's huge.
Now, Ashley, you really started this off by talking about diversification.
Right.
And how you diversify. There's another diversification method that we can utilize.
Okay.
We talked a little bit about time frames of index of indexed accounts, that you can have a 2-year segment, you can have a 3-year segment, you can have a 1-year segment, you can have a 5-year segment in some carriers. It's a long segment, which means that just using the S&P 500 as another example is the same example. Point to point, 1 year. Point to point after a 2-year period of point to point after a 3-year period. And you can end up offering larger participation rates the longer that you go, because the option cost is much smaller for a 2-year segment, which means you can end up getting that much more of a participation rate, and even more for a 3-year segment that's out there.
That could be a way for an investment advisor to ladder these accounts within these policies.
Exactly.
And earn more later on.
Just like bond laddering. Exactly.
All right, so let's get real. The ugly side of these contracts.
Oh boy.
What can a client expect if everything goes wrong in these contracts? What is the worst case scenario? The bad hair day, you name it, that the client comes in, they're pissed. They weren't happy with their contract. What does that look like?
Well, a client not being happy with their contract is really all about them not seeing the performance that was illustrated to them to begin with.
True.
And the entire conversation that we're having here is about how do we make that illustration perform the way that we illustrated it to the client day one.
Originally, yeah.
Okay? The idea here is that there are trade-offs to everything that you end up doing in an investment. An investment is an investment, it's not a guarantee. So if you should go out and you should invest in a 3-year bucket, and that 3-year bucket makes no money for that 3-year period of time, that's a trade-off.
Yeah.
Right? Or if it doesn't make any money within the 2-year bucket or the 1-year bucket. But the idea here is that diversification should go out and make that up over a period of time. You're not putting all of your eggs in one basket.
And it brings you back around to those annual reviews. If something should underperform, that's where you can make that change.
That's right. So remember, these are fixed indexed products with a 0% investment floor.
Yeah.
We can't guarantee an investment, but we can certainly manage the investments as long as the client is willing to go through that annual review and discuss what should end up being done. And you have a little bit of an investment thesis in back of you. But that's where our company comes in, and that's why we're so much different than all of these other companies, right?
Right.
We actually support that advisor through that process. Hey, Ashley, what do I end up doing with this? Should we diversify the bucket from the S&P 500? Well, we have this forecasting company out there that we employ. It's called the Indexed Standard. It's an independent company. They go out and they take a look at all the historicals of all of these indexes. They end up having analyst forecasts of where these indexes are going to go. So if an index is forecast to go at 0%, why would you invest your money in that index?
You shouldn't.
You shouldn't.
Yeah.
Right? But if an index is forecast to end up doing 4 or 5%, why wouldn't you invest that one versus the 0% one?
Absolutely.
But people don't change their buckets.
They're not looking.
So they should come to a sophisticated company because these are sophisticated products today. It's not the days of old where you go out and you develop an illustration and it's done. You never see the customer again. And then the customer becomes dissatisfied. You want to have a contract that's going to perform up to snuff, and we can help that advisor go out and administrate that using some of the resources and tools that we have.
That's a huge advantage for why professionals should be with Fortress Brokerage Solutions. Having a team that they can rely on that has that industry knowledge and expertise to continue to provide them guidance beyond just the sale to help them keep that customer happy, I think that's key.
So, I've helped to build products for insurance carriers out there.
Okay.
So I know where the insurance carriers make their money, where they can go out and they can trim a little bit to give a little bit more to the customer, what the triggers are on what the companies can end up doing to moderate the contracts on the other side. I love uncapped indexes. Because the capped indexes have come so far down, I just don't think that you get the return on your investment on the other side.
Yeah, I would agree with that.
Okay. Now, there is a season of the economy where you should end up having your money in that capped index. I'm not saying it's all bad as far as the capped index, or maybe it should be a small percentage of your portfolio. But you want to figure out how to maximize the value of those accounts. If you're going to end up limiting yourself to some of these lower caps that are on out there, some of the caps are as low as 5.5%.
Yeah, you're not going to make where you should be making elsewhere.
And if the
could be making
and
elsewhere.
if the expenses inside of the contract are 2.5%, I mean, you're not making that much money in the contract. You need to end up making a significant more than what the expenses are in the contract for cost of insurance, the acquisition costs, the SG&A inside of the life insurance contracts. And that's what we help the insurance advisors to go out and look at. It isn't just underwriting,
right,
which most people think. It's not just illustration. It's about everything for these sophisticated products that are out there.
Absolutely. You definitely make the case for why a sophisticated insurance professional should be working with Fortress Brokerage Solutions.
Exactly.
Brilliant insights. Thank you for sharing.
Oh, thank you for having me.
Absolutely. Before we get going, guys, we have a special white paper to give away to you guys today. If you follow the link in the description, you can get access to our partial credits, an index strategy that we talked about here today together, as well as the ability to earn in a negative environment. That's a proprietary indice that we offer, and some valuable material that you can get through this white paper that we're offering here today. That wraps up our final episode of Inside the Fortress. I appreciate you guys taking the time to watch with us today. Please share and like this video, as well as provide it to some of your friends and fellow advisors. Thanks for spending the time, and keep learning. Have a great day.